Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Absolutely. And today's topic is definitely one that needs breaking down.
Yeah, it really does. Because I want you to imagine a world where the U.S. military's, overwhelming might is completely neutralized and not by another army, but by something like a commercial insurance premium.
Right, which sounds crazy, but that is exactly what we're looking at.
Exactly. So today we are taking a deep dive into the hidden economic and market ripple effects of the recent 7-week U.S.-Iran conflict.
And it is a massive web to untangle.
It really is. Because, let's be honest, for everyday American beginner investors watching the Trump administration navigate these incredibly tense global waters, well, it can be really hard to know what it all actually means for your daily life.
Oh, for sure. The nightly news gives you like the play-by-play of the military maneuvers, but they rarely show you the financial fault lines cracking beneath the surface.
Right. And those fault lines are what actually dictates inflation and, your standard 401k or your grocery bill.
Exactly.
And that is exactly our mission for this deep dive. Based on recent analysis and data, we are translating these complex geopolitical shifts into simple terms.
We'll explore why having the biggest military doesn't automatically fix the stock market.
Right, and we'll look at who the surprising financial winners are behind the scenes, and how you, the everyday investor, should react. Okay, let's unpack this.
Let's do it.
We have to start with the biggest player on the board, the U.S. military, and look at why the old rules of global power are basically changing.
Yeah, what's fascinating here is that there is a fundamental shift happening right now. It's a shift in how hard power translates, or more accurately, fails to translate into economic stability.
Right, because the U.S. obviously has overwhelming military power. You can look at it like a giant sledgehammer.
I love that analogy.
Yeah, because a sledgehammer can smash through almost any physical wall.
Right.
But when you look at our global supply chain or our energy markets, they don't look like a concrete wall.
No, not at all.
They look like a highly sensitive, fragile computer circuit board. And you can't use a sledgehammer to fix a circuit board.
You really can't. You'll just destroy it.
But here's what I want to challenge you on. Based on the data, the U.S. didn't retreat. They maintained a very strict blockade on Iranian ports.
They did, yeah.
They were heavily armed, ready to strike. If they had the sledgehammer raised and, held the absolute physical advantage, why did the data show they desperately needed a middleman to sort this out?
Well, because holding a physical choke point and negotiating commercial safe passage they're two entirely different things.
Okay, that makes sense for me.
Sure. So a sledgehammer can enforce a blockade, absolutely, but it cannot force a commercial maritime insurance company to underwrite policies for cargo ships navigating the Hormuz Strait.
Oh, wow.
It cannot draft the highly technical terms of a nuclear agreement either. And it certainly can't handle the complexities of post-war compensation.
Those require a scalpel, not a sledgehammer.
Exactly. They require back-channel diplomacy that a military standoff inherently prevents. You can't shoot and negotiate the finer points of maritime law at the exact same time.
So the military might creates the standoff, but it completely lacks the mechanism to build the bridge that ends it.
You nailed it. And the trade data from April shows the direct result of that limitation.
What does the data show?
The U.S. ultimately had to rely heavily on diplomacy to find an off-ramp. Based on the logs, the U.S. engaged in the highest-level direct talks with Iran in half a century.
Half a century? That's huge.
It is. And the location of those talks is what is truly wild. It was in Pakistan.
Wait, Pakistan?
Yeah.
I think for the average American beginner investor, Pakistan isn't exactly the first country that comes to mind when we think about resolving a Middle East crisis to save global market volatility. Why them?
This is the paradigm shift you have to understand. Pakistan operates as a middle state with unique leverage here.
Because of geography?
Partially, yeah. They share a border with Iran, they have deep historical ties, but they also maintain vital relations with Western powers.
Oh, so they can talk to everybody.
Exactly.
Yeah.
On April 11th, and again on April 13th, talks happened in Islamabad. And by April 17th, an Iranian official actually noted that a preliminary agreement was possible, specifically citing this mediation.
That is wild.
On April 17th, Pakistan actually provided massive aerial escorts for the Iranian delegation. That's a massive display of logistical and diplomatic trust.
So what is the takeaway for the listener's portfolio here?
The takeaway is that geopolitical risk is no longer just about who has the most aircraft carriers. It is about who holds the dialogue channels.
So if I'm looking at my investments in energy or, say, global logistics, I shouldn't just be tracking troop movements on the news.
Right.
I need to track these middle states because they are basically the new referees of global trade.
They really are. They're the ones building the actual scaffolding that allows markets to calm down and ships to sail again.
Okay, so while the U.S. was busy relying on these referees to cool things down, let's look at the people watching from the sidelines.
The rivals.
Right, because while the U.S. is distracted, its main global rivals are reacting to and profiting from this exact situation.
Yeah, the ripple effects here are creating some deeply counterintuitive winners and losers in the global economy.
Let's frame this with a neighborhood dispute analogy.
Oh, I like where this is going.
You've got two houses on your block, locked in this massive, loud fight, right? Everyone is staring out their windows. Meanwhile, the guy down the street, let's call him Russia, is quietly selling snacks to the spectators at a massive markup.
That's spot on.
But to make that totally accurate to the data, Russia is also actively trying to lock the doors of the local grocery store so the regular delivery trucks can't leave. They aren't just passive.
That addition makes the analogy perfect, honestly. Russia is undoubtedly the clearest indirect beneficiary of this entire conflict.
Really, the clearest winner.
Yes. European Council President Antonio Costa stated this point blank on March 10th. He basically said, the only winner of this war is Russia.
Why is it so definitively Russia, though? Explain the mechanics behind that for us.
Russia benefits simultaneously on a few distinct fronts. First, higher global energy prices pump cash directly into their economy.
Because they sell oil.
Right. But they aren't just selling raw oil, they are capitalizing on refining margins.
Okay, what does that mean exactly?
That is the gap between what it costs them to extract the oil from the ground and what desperate, energy-starved countries are willing to pay for finished fuel.
And that gap is widening.
Massively. Second, the global focus on the Middle East completely distracts political and media attention away from the conflict in Ukraine.
That makes sense. It takes the heat off them.
Exactly. And third, physical military resources that might have gone to support Ukraine are being diverted to the Middle East instead.
Wow. But the refining margin piece is crucial. And here's a data point from April 18th that totally blew my mind when I read the analysis.
Let's hear it.
The U.S. actually extended a sanctions waiver on Russian oil sea trade. The Trump administration literally gave a pass to Russian oil.
Yeah, they did.
Why on earth would we do that if Russia is the primary rival benefiting from this? It sounds completely backwards.
It is the ultimate geopolitical irony, but it's driven entirely by domestic economics.
Meaning what? The American consumer.
Exactly. The administration is trying to cushion the blow of this Middle East shock for the everyday American. If they strictly enforce sanctions on Russian oil right now, global supply shrinks even further.
And the price of gas at your local pump skyrockets.
Right, to a level that causes severe economic pain and, frankly, massive political backlash. So to protect the American consumer's wallet, they essentially had to throw a temporary lifeline to Russia's cash flow.
So we are allowing them to sell the snacks at a markup because we're just too starved for energy to stop them.
That's exactly it.
Okay, so what about China? Because the standard narrative you hear is that anytime the U.S. is distracted or bleeding resources, China automatically wins.
Yeah, and that is a very dangerous assumption for any investor to make right now.
Really?
Oh, yeah. China is acting as a calculating observer, for sure. On April 13th, they publicly criticized the U.S. blockade in the Hormuz Strait.
Right, playing the diplomat.
Exactly. They are absolutely using the situation to expand their diplomatic influence on the cheap, positioning themselves as the voice of reason.
What?
But the economic reality is that they are paying a steep, staggering price.
Walk me through the mechanics of that price. Because China is basically the manufacturing hub of the world. They run on imported energy.
Exactly. Between January and May of 2026, China's Middle East oil imports dropped by an incredible 28%.
Wait, 28%? That is huge.
It's massive, and their total global oil imports dropped by 10%.
Is that because the oil literally wasn't being pumped, or is it a logistics issue?
It is a logistics and insurance issue. It goes right back to our earlier point about the sledgehammer.
The maritime insurance premiums.
Right. Traversing the Strait of Hormuz became so astronomically expensive that Chinese cargo ships and supertankers simply couldn't afford to make the trip.
So the supply chain just halted because the math stopped working.
Precisely. By April 17th, the pain was so acute that China's Economic Planning Agency officially announced a forced pivot toward energy diversification and expanding their strategic reserves.
So for the listener, do not buy the surface level China is winning narrative.
Absolutely not.
Sure, they scored diplomatic points, but economically, their manufacturing margins are getting totally crushed by these supply chain disruptions.
Right. Russia cashes the checks, and China pays the higher freight costs. You really have to separate diplomatic posturing from actual corporate cash flow.
That is a great rule of thumb. Okay, so while China and Russia are playing this margin game, the collateral damage is spilling right into the lap of the broader global economy, specifically hitting our allies and developing nations.
Yeah, the numbers here are pretty grim.
Based on recent analysis, we are looking at a massive physical loss of resources. Over 500 million barrels of oil and condensate vanished from the market in just 50 days.
If we connect this to the bigger picture, let's break down what that actually means. 500 million barrels is a staggering figure. It translates to a loss of over $50 billion.
And let's clarify condensate for a second, because that's a term thrown around in financial news a lot, but most people don't know what it is.
Good point.
It's basically a highly valuable ultralight liquid form of natural gas. Right?
Correct. It's the essential ingredient that makes gasoline blending possible, and it feeds the entire global plastics and petrochemical industry.
Oh, wow. So it's in everything.
Everything. So when millions of barrels of condensate vanish, it's not just the price of gas going up at the pump. The cost to manufacture the plastic casing for your television goes up.
The synthetic clothing, medical packaging.
Exactly. It creates broad, inescapable inflation across the board.
And you just can't erase $50 billion of foundational commodities from the earth and not feel it in global growth.
You really can't. And the International Monetary Fund, the IMF, issued a very stark warning about this in their April report.
What did the report say?
Their initial baseline for global growth was 3.1%. Because of this conflict, they warned the world is shifting toward a much worse 2.5% scenario.
That's a big drop.
And it gets worse. If we see a severe, prolonged shock, global growth could plummet to 2.0%.
2.0% global growth is basically stall speed. That is a recession warning light flashing red for the entire global economy.
Under that severe shock scenario, the IMF projects oil hitting $110 per barrel in 2026 and $125 per barrel in 2027.
Ouch. For the beginner investor, $125 a barrel translates to absolute pain.
Oh, yeah.
It means skyrocketing grocery prices because diesel for delivery trucks costs more. It means airline tickets become unaffordable. It hits every single sector of your standard retirement portfolio.
And it hits vulnerable countries even harder. IMF chief Kristalina Georgieva warned that at least 12 countries might need emergency new IMF programs just to survive this shock.
Let's explain how that mechanism works. Why does an energy spike force a whole country to need a bailout?
It comes down to sovereign debt crises and currency devaluation.
Okay, break that down for me.
Imagine a developing country that borrowed $1 billion to build infrastructure. Those loans are almost always in U.S. dollars.
Right.
Now, this country also imports all its oil. When oil prices spike, inflation hits their local economy, and the value of their local currency drops compared to the U.S. dollar.
Ah, I see where this is going.
Suddenly, it takes twice as much of their local money to buy the U.S. dollars they need just to pay back that original loan.
So they get squeezed by the high price of oil and the crushing weight of their debt at the exact same time.
Precisely. That is how an energy shock turns into a full-blown debt collapse.
Which means emerging market investments are splitting into two distinct camps.
They are.
If a country exports raw materials, like copper or agricultural goods, they might survive. But if they import energy and have high debt, they're basically heading for a cliff.
Exactly. You can't just buy a broad emerging markets index fund and assume it's safe anymore. You have to look under the hood.
That makes total sense. And we haven't even touched on Europe yet.
Oh, Europe is in a really tough spot.
Because they are incredibly vulnerable, getting squeezed on two fronts, right?
Very much so. On April 16th, it was reported that the U.S. delayed weapon deliveries to some European countries.
Why?
Because American inventories were depleted by the Middle East situation.
So Europe has to suddenly spend billions more to shoulder its own defense burdens, right as their energy costs are going through the roof because of the Hormuz Strait disruptions.
Yep. It's a brutal double squeeze on the European economy. It fundamentally damages the profitability of major European industries like German manufacturing, which rely heavily on cheap energy and stable export routes.
Speaking of getting squeezed, let's talk about the allies sitting right in the geographical crossfire,
Mm,
the Gulf states.
this is a huge piece of the puzzle.
How is their relationship with the U.S. changing? Because from what I'm seeing, the Gulf states are looking at their relationship with the U.S. like a premium home insurance policy.
Right.
They've paid top dollar for decades, hosting bases, aligning policies. But now that a massive regional conflict has crashed right through their roof, they feel like the insurance company, the U.S., is suddenly hesitating on the payout.
That is the perfect way to visualize it. The alliance isn't collapsing, but it is becoming highly, highly transactional.
Transactional in what way?
The Gulf states are basically looking at the terms of their geopolitical insurance policy and demanding revisions.
What kind of revisions do the recent data show they actually want?
According to reports from March 27th, the Gulf states are demanding structural physical limits on Iran's drones and missiles.
So they want hardware restrictions.
Exactly. They are telling the U.S. simply calling a ceasefire and pausing the war isn't enough anymore. We need physical, verifiable guarantees that our oil refineries and shipping ports won't be targeted tomorrow.
They want the root problem solved, not just a Band-Aid.
Exactly. Anwar Gargash, a senior UAE official, made this incredibly clear on April 6th.
What did he say?
He stated that the U.S. remains their core security partner, but he added a massive caveat. Guaranteeing safe navigation in the Hormuz Strait must be explicitly written into any new agreement.
Wow. So they aren't abandoning the U.S., they're just forcing the U.S. into a much more expensive, specific contract.
That's a great way to put it.
What does this transactionalization mean for the American economy, though?
It means higher baseline geopolitical costs going forward.
Because peace is getting more expensive.
Exactly. The U.S. will have to spend more money, commit more military resources, and offer more guarantees just to maintain the exact same level of regional stability we took for granted a decade ago.
And when the government spends more on overseas security, that filters down into higher baseline inflation and higher taxes for the American consumer.
It always does.
Okay, let's bring this directly back to the listener's wallet and their investment blueprint.
Let's do it.
Based on the data, when the Hormuz Strait briefly reopened on April 17th, oil dropped 10%, and global stocks bounced back.
They did, yeah.
It felt like a massive sigh of relief across the markets. So, for the beginner investor looking at their 401k, was that the signal to relax? Is the worst over?
This raises an important question for anyone managing a portfolio today. And the short answer is absolutely do not let your guard down.
Really? Even with the 10% drop?
Yes. That 10% drop in oil was a temporary sigh of relief, not a structural fix.
Why is it a trap?
Because the underlying mechanisms of the conflict haven't changed at all. The U.S. blockade still continues. Iran has explicitly warned they could close the strait again at any moment.
Oh, wow.
Furthermore, the broader nuclear negotiations are entirely incomplete. The deep structural causes of this conflict have just been paused. They haven't been resolved.
So that bounce was just the market taking a breath, not actually recovering.
Yes. For the everyday investor, your blueprint in this unstable order shouldn't be about guessing the direction of oil.
Don't try to time the market.
Exactly. Don't guess if oil goes to $80 or $120 next week. Instead, you need to structure your investments around the persistence of volatility.
Which means looking at how your mutual funds or index funds are weighted.
Right.
If your portfolio is heavily exposed to assets vulnerable to sudden energy spikes like airlines, chemical manufacturers, or European consumer goods, you need to understand that a sudden closure of the strait will crush those margins overnight.
Exactly. You want to look for broad sectors that maintain their pricing power even when the world gets messy.
Like what? What's an example?
For example, European defense stocks, or maritime insurance companies, or the global logistics companies that actually know how to efficiently reroute supply chains when a crisis hits.
Oh, that's smart. They get paid to fix the mess.
Exactly. Or companies deeply integrated into alternative energy supply chains, because every nation on Earth is currently desperate to stop relying on Middle Eastern oil.
It's about shifting your mindset from how do I profit from peace to how do I protect my wealth against volatility? Well, that brings a lot of clarity to a very chaotic situation. We've traced the path from military blockades to maritime insurance, from Russia's refining margins to the inflation hitting the American grocery store. Do you have a final thought to leave the listener with?
I do, actually. If diplomatic networks and middle state mediators like Pakistan are the new arbiters of market stability and global trade, What happens to your 401k and the global supply chain when the next conflict erupts in a region where there is absolutely no neutral middleman willing to step in?
Don't forget to subscribe and hit that like button.